Hi, I'm Zach Gast, a member of the International Accounting Standards Board. I'd like to welcome you to this short video intended to introduce you to the IASB's proposed disclosures around supplier finance arrangements, which you'll more commonly hear described as reverse factoring, and to explain how you can provide feedback on those proposals. Before we talk about the specific proposal, I'll provide some background on how the IASB and the IFRS Interpretations Committee have each addressed the reverse factoring issue. After discussing the proposed disclosures, I'll explain why we need feedback and how you can provide it. We'll begin with the background. Let me start by saying that I'm assuming for this discussion that you're familiar with reverse factoring and other supplier finance arrangements. If not, hit pause and please first watch our separate presentation that provides that background. As we begin, it's worth discussing how we got to this exposure draft. At the beginning of 2020, a credit rating agency submitted questions to the IFRS Interpretations Committee on how IFRS standards address the issue of reverse factoring. If you're not familiar with IFRIC, the Interpretations Committee, this is a committee of the IASB that responds to questions about how current standards address a specific issue, and which can, if necessary, make recommendations to the IASB to undertake targeted improvements to those standards. In its submission to the Interpretations Committee, the credit rating agency explained why reverse factoring had become such an important issue for investors and asked two key questions. First, how should a company present liabilities associated with reverse factoring arrangements? And second, what information about reverse factoring arrangements is a company required to disclose? The Interpretation Committee's response to those questions was that the standards adequately explain how to account for these arrangements on the balance sheet using existing principles. That allows for a variety of treatments depending on circumstances. The most common will likely still be that payables subject to supplier finance arrangements remain in trade payables. In other cases, though, a company will extinguish their trade payable and create a new payable, denoting that it results from a financing relationship. The committee also flagged that liquidity risks should be disclosed as they relate to supplier finance arrangements, and they noted that where a company extinguishes a trade payable and creates a new payable, the cash flow can create a non-cash transfer in the statement of cash flows that is subject to disclosure under separate IFRS principles. From that decision, the IASB decided to look into whether additional disclosures would improve financial statements and develop the exposure draft we released late last year. Before we discuss the disclosure requirements, I wanted to first highlight what the IASB did not address in the exposure draft. First, we are not addressing disclosures around either receivables finance or inventory finance. While both are also working capital arrangements, my personal view, and I won't speak for the board here, is that the information needs are different enough that expanding the scope of the project would significantly delay progress on the more narrow issue we were asked to address. Factoring or securitization are inherently an acceleration of cash flows, while reverse factoring reflects a delay in payments. Those are handled identically in finance, but the information needs around both are quite different when we get to the accounting. The exposure draft is only focused on disclosures as well. We did not attempt to change the current presentation requirements, which don't require trade payables to be extinguished and replaced with supplier finance payables. With that, we can turn to what is in the exposure draft. In developing our proposal, the IASB began by talking to investors about what their information requirements are and why they need that information. We can then take those information requirements and not only use them to tailor better disclosures, but also to explain to preparers why financial statement users want certain data points. At the risk of oversimplifying, user information needs came down to four basic points. First, does a material supplier finance program exist? I haven't included that on the slide. Two, if the program does exist, what level of usage does it have, and how can I use that information to adjust a company's reported debt outstanding in my own way? And I'd put emphasis on that last bit. What we found is that there's enormous diversity in how investors adjust debt, as well as some of the items we'll discuss later, using the same piece of information for a company. This is part of the reason we didn't create a mandate that a company simply do the math itself and present investors a certain number. It would be a standard number, but not one that fits the precise needs of many investors. The third point or information need was, is the supplier finance arrangement affecting a company's liquidity risk profile? And if so, how? And last, based on the usage of the program, what are the adjustments to operating cash flows that I need to make to separate out the effects of the supplier finance arrangement from the operating condition of the company? So this slide begins with what we call a disclosure objective, which summarizes our information requirements from the prior slide. Before we talk about the exact disclosures, I would flag for you that we created a fairly broad definition of supplier finance arrangements. The idea behind doing this was that if we were too precise, the programs could be modified slightly and continue without disclosure. So for each program captured in our definition, a company would need to make required disclosures unless the terms and conditions of the programs were close enough that they could be aggregated together. I'll break out the required disclosures in the proposal into qualitative and quantitative buckets. The qualitative items would include the terms and conditions of the arrangements, as well as the discussion of the liquidity risk the company faces. Quantitative disclosures would be reported for the prior period and current period and would include, first, the amount of invoices approved for participation in the program, which is B1. The amount of those invoices in B1 that had been paid by the finance provider, and this is B2. Next, we come to the range of payment due dates for all liabilities included in the program relative to those trade payables not in the program. So we want to see the difference between what the payment terms are for things that are in the program versus outside, and that composes B3 and 4. There's a lot of words here, but we've got a simple example of what the disclosures might look like in the next slide. And here you can see what those disclosures might look like in practice. It's a very simple example, so we don't have supplier finance payables broken out separately if they were subject to financing, but those would be required if they did exist on the balance sheet. At its simplest, and I want to emphasize that this is not how all investors might treat these items, an investor could use the credit union 1050 to adjust current debt levels at 31st December 2021. They might also deduct credit unit 250 from operating cash flows. So this is the growth in actual financing within the program during the period. If there were non-cash transfers from trade payables to finance payables, they would deduct the entire amount of those transfers from operating cash flows. This lets you see how an investor might use the information we've required to make adjustments to the things they said they would like to adjust, but clearly the methodologies will differ from investor to investor. And next we come to the portion where we ask for your view. So the most important part of this process is that the IASB hears back from stakeholders on what we've gotten right and where you think we might need to make some changes to our proposal. We've listed some of our key questions here, but there's much more detail on both the proposal and how you can provide feedback on our website. If you head to ifrs.org, navigate to projects, and then find those open for comment, you'll see the full proposal. In addition, I'm always available to connect if you have any questions. With that, I'd like to thank you for taking the time to join us and hope you've enjoyed the video.